Hello, everybody.
Hello.
Hi, guys. I run this meetup with my husband, Julian, and another fabulous couple, Chris and Angela over there, and they brought their little baby, Olivia.
The newest member here.
The newest member of our meeting.
How old is she? She's 7.5 months now.
7 months old, guys.
Yeah.
So we host this meetup to provide you guys with an opportunity to network with each other, and so that you can find someone who will make a positive impact in your life and hopefully propel you forward in your real estate journey. First and foremost, we want to thank Navigator Taproom for letting us use their venue for a couple of hours every month. So let's show them some support by buying a glass and having something to drink. There's also pizza. That's totally new. I came here one time and I was starving and I got drunk and it was not good. If you haven't already, please sign in with the QR code. We do not spam you. We just use it so that we can send you the alert that we've posted this meeting on YouTube. And if there were slides, that we would send you slides, stuff like that. Nothing like buy something from me. And then no further ado. We are so excited to welcome the founder of Drexel Properties, a company that manages over 900 units in Chicago's North Side. He has over 2 decades of experience in real estate investment and property management, but he is not just a seasoned investor. He is also a leader in the real estate community. He is the founder of the Northwest Side Building Coalition and an executive member of the NBOA. Outside of real estate, he's a philanthropist who mentors Chicago youth and also an avid traveler and a worldwide marathon runner. He'll be sharing his 1,000 unit vision, a strategic blueprint for scaling a multifamily portfolio. I'm excited to welcome Jeff Weinberg.
Hey, everybody. Could you hear me if I don't have this microphone? Could you hear me in the back? Okay. So I don't need this, right? I'm gonna put this down. I don't want to sit here holding something in front of my face the whole time. First off, thank you for the introduction. You know, y'all all of a sudden get to be my age, and you're hearing introductions like that, and you're like, how do you have time to do all that? And you know, over years you do. So first off, by way of just a little bit more on me and my background. So first off, I am a lifelong Chicagoan, born in the city of Chicago on the north side. I currently live in Lakeview. I have 3 kids, all in their 20s. I raised a family in the city, so you could do it. I guess despite what you hear and what they say about the city of Chicago, we do have challenges. We do have lots of headwinds. But this is a great place to live, to have a career, to thrive, to eat good food, to go to good museums, and exist. So we're all in a really good place, and I think the future looks as bright as the past does if we look back. In terms of me, I have a background. I started out in information technology. I graduated college in 1986. You could do the math to figure out how old that makes me. But I graduated college. I went to work for a boutique consulting company. I spent about 10 years at that company. I got involved with some internet startups in the late 90s, early 2000s when that was all going on. And I was always interested in real estate. When my friends started buying condos, because that's what you do, I just had this sense that I wanted to own the dirt. I wanted what was underneath the property. This notion of owning a box in the sky just didn't compute in my mind. And I bought in 1992, I bought a 2-flat in West Lakeview, just east of Roscoe Village. Sleepy, no man's land, nobody was living there, nobody understood where it was, but I bought this great 2-flat and it worked out. In 2002, so I'm jumping forward, I had an opportunity to invest with some people in a 20-unit building in Hyde Park, and I bought the building, and after buying the building, and I'd been talking about real estate, probably like everybody in this group, within my network, I was talking about my interest in buying real estate. I thought this is a real good way to make a living, make money, create wealth over time. Coming from the technology and consulting world, where your assets are your people, and your people, first off, they talk back to you and they disagree with you. They also go home every night. You can only earn an hour of profit for an hour of work, which means to scale, you have to hire more people, which is more problems. In any case, I bought this 20-unit building, and I got calls from 3 or 4 people saying, hey, you've talked about real estate, you just bought this, you're gonna buy another one, I'd be interested in investing with you. So that's really what kind of got me going into all of this. So I bought a 20-unit building. I'm gonna spare the details because I ultimately wanna allow you to ask questions of me, but I ended up, I bought another building, partnered up with somebody that I had gone to high school with who was also investing in apartment buildings. He had a property management company. We bought a few things together, and that really kind of got me going. When I started this up, and I think this was the critical thing of my success, you're buying an apartment building, and we kind of all know what that means. I guess I'm curious, and just with a show of hands, how many in the room own any kind of real estate today? All right, good. So we've got a good number of people who are already investing in real estate. If you're running an apartment building, you've got lots of moving parts. You've got residents, they're coming and going, they have needs, they have service requests that need to be taken care of, then you have to fix those things, you have to collect the rent, you have to pay the bills, you have to keep that all organized because eventually you have to do this thing called taxes. So from my background going into this, even though I owned the building, I mean, there was a group of people that owned it, but even though I owned this just one apartment building with 20 units in it, I just had the sense to build a system to maintain it. Kind of a funny story because there was no Buildium or Appfolio or any of these tools at that time. You start a business, you go out and buy QuickBooks, and I spent a month trying to figure out how to make QuickBooks work, and then I finally thought somebody else must have done this before, so I started searching on the internet, and QuickBooks property management, and some guy had a template, and I used his template. But I built the system and processes for managing everything. Even though it was one building, even though I owned it, I still intuitively just felt like this stuff needs to be organized or it's going to be difficult to scale this. And my goal was to buy as many apartment buildings as I could. The first person that I hired was somebody to do my books, to just do data entry and bookkeeping for me, because that was the most important thing to do, and that was something certainly I could offload because my expertise was more in, first off, from a buying property perspective, now I'm saying this from the perspective of hindsight, but I had just a good sense of how to look at, find, negotiate, and make deals, but I also had a sense of service and customer service, because that's the other component of this. If you're running property management, if you have tenants, they're your customers. They have a year-long lease, so they're locked in for at least a year, but you really have to treat them like they have a choice every day, just like they're coming into a restaurant. Because if they come home and they're not happy with where they live or the service that they're getting, and every day they come home and they're not comfortable with coming into their own home, you got a problem. So my sense was, let me focus on making sure that the residents were happy. Kind of that back office data entry stuff is something that anybody could do, and I could hire somebody and teach them how to do that. So I just started building. Now, when I first started out, I took advantage of something called Class 9. It still exists, but it doesn't really provide value. But back in those days, I could buy a 20-unit apartment building. I could then put in, the pricing is very different when I look at it today, because I could put in a new boiler. These are central boiler buildings. I could put in a new boiler, 100% new windows in the building, and a new roof, and usually a new hot water system, and that would cost me $150,000, roughly speaking. And that would reduce my property taxes annually by about $15,000. So do the math, right? That's a really good investment. And then when you fold that into the building, you've got a really good value that you've added to it. And again, when I first started out today, and for a long time, I buy and long-term hold. But when I first started out, I needed income. I needed to create cash flow. I had 2 small kids at home. shortly thereafter, our third small kid at home. And so the goal was buy it with the notion that I'd exit in 18 to 24 months. And it worked out really well to kind of build that model and grow. I should say that I started out Drexel Properties. Drexel runs through Hyde Park. 3 of my first 4 buildings that I bought happened to have been on Drexel. So we started calling ourselves Drexel Properties when we'd answer the phone. Hello, Drexel Properties. And I finally sold the first building, which actually was Drexel Properties, LLC. I finally took that back and I moved the whole company business under that legal entity to do business because that's who we were and obviously that's who we are. So that's grown to where we are today, and today we're all on the north side. We have properties in Logan Square off of Kedzie and Milwaukee, and if you follow Milwaukee down into Portage Park, we've got properties kind of all around the Portage Park, off of Long and Irving Park. If you come east, we've got properties down Irving Park, almost all the way to the lakefront, and then if you go north from there, we've got properties in Buena Park, in Lincoln Square, in Lakeview, in Ravenswood, all the way down to East Rogers Park. So we manage about 65 buildings, about 950 units, about 500 of those units I actually have ownership in, and then another 400 of those units are third party. A few years ago, I started looking at my business and thinking, okay, where am I going with this? What am I going to do? What's my succession plan or my exit strategy? Being that I built this management company, which I think is a wonderful company, my kids are not interested in taking it over, so I made a conscious effort to grow the business to make it be able to be sustainable without me at the helm of it every day. So I hired some key people to come into the business. We took on third-party management because to be of value outside of me, there's got to be some balance beyond me. So we took on third-party management, and I actually will kind of end all of this, and then I want to just turn it around and find out what your burning questions are and maybe where you're stuck or whatever. But we made a public announcement of this about a week ago, but we actually sold Drexel Properties. We merged it with a new startup called Proper XPM. It has a relationship with some other developers, a technology platform called Lively, which is a resident experience platform, and they're building tools, particularly on an AI platform, to really automate workflows that will streamline everything that a property manager does so that we could be more productive with fewer people, more responsive to the needs of the tenants. And so it's kind of, so you were asking me about my technology background earlier, and for me it's exciting because I'm really kind of coming full circle, because for years I've been looking at how could we automate different processes so that we could be better at what we do, and that's where we're going. So those are some things that are going on. So the future looks pretty good with the management company. We're going to continue to acquire properties. We're going to continue to grow our management company. But I think with that, when I was invited to speak today, I was asked to talk about strategic growth, managing through the chaos, and I could talk to each of those things, but I'd like to open it up and let me have you ask me questions, and then I could be more direct to what you guys are interested in.
I do have the mic, so I want to make sure that the person asking the question gets the mic so that for recording we can know what the other person is
saying. And I just want to point out, Sean could only ask every other question at most.
So, Jeff, great, presentation. Obviously, you're one of the. Oh, I have to speak louder.
So the people in the back.
Oh, okay.
Do we have to hand him the microphone?
So, Jeff, great presentation. Obviously it's very impressive. So, when you started back in 2002, I believe, I think, yeah, okay. Did you buy value-add properties or distressed assets or more turnkey properties with, management changes? What kind of properties were you looking for when you started initially? And then how has that thing transitioned? In the last 24 or 23
Okay.
more years. Yeah.
All right. Everybody heard the question? So the first building that I built was fairly turnkey, but I do remember all of the bathrooms had tubs in them. There were no stand-up showers, so they were old claw-tooth bathtubs. 20 apartments. I converted all 20 of them into a conversion kit that made it into a shower. I did them with my own hands. I painted half of one apartment, and I concluded I'm not painting apartments. So that building was fairly turnkey, though. It was a natural kind of upgrade to make it a little bit more appealing. But to answer the question. The best thing to buy for me, probably for anybody in this room, is something that is run down and can be fixed up in some way, shape, or form. That's the best way to add value, with the assumption that this is the baseline of where the property should be. When rents comparative are there, but the value of the property is down here because nobody's interested in it. So if you're paying this price for this property, not a good idea. But hopefully you could pay the price for this property, and for every dollar you put in to bring it here, hopefully puts out more than $1 in return, so that it's worth doing it. So, but when I really look at properties and I look at what I've acquired in terms of the portfolio that I own, it really is almost always opportunistic. We bought starting at the opposite end of this, we bought a building 2 years ago. 2016 construction. At the time, it was the largest purchase that I ever had done. It was $12 million that we bought this thing for. It was worth easily $14 million. The person that the guy that developed it, he was a condo developer. He all of a sudden got caught in 2008 with what happened in the market. Then he held on to this property, and then he built these 2 final buildings with them to be apartment buildings, not condo buildings. And then he hired his condo salesperson to sell these buildings. And selling a condo is like selling a home. Selling an apartment building is selling a business, a very different thing. And we saw that it was mispriced, it was mismarketed, and we jumped in there and we made an offer, and we used a lot of different tools that we had to get them to accept our agreement. We bought this thing. It appraised for considerably more than we paid for it.
Wow.
And we moved rents up and did the things that make it valuable. But what I'm really getting at is, if you're buying real estate and you're looking at everything out there, I say you've got to kiss a lot of frogs to find the prince. It's looking for the opportunity. Sometimes somebody's under some kind of loan situation. We had a situation where somebody had a CMBS loan. I did not know what a CMBS loan was at the time, but it was a property that we had been looking at. We made an offer on it. It didn't happen. It fell through. Then it comes back to us 6 months, a year later, and it's like, well, we made an offer. We'll offer you the same thing that we did before. That's what we're willing to pay. Allegedly, this debt that was required to be assumed was gone. Well, we put the offer in, and it turned out that it was still there, but they offered us a significant discount to buy it at that price. Now, the interest rate on that loan was like 3.59, I think, at the time. This is a few years ago. This is 2020, just to give you a timing on it. But interest rates were moving up, so interest rates were 5% then. So, I'm sorry, I'm saying this backwards. The loan, you could get loans for under 4%. The loan on the property was 5.5%. But it was year 7 of a 10-year amortized term, which means that we're paying more principal on the loan. And they gave us such a good discount on it that it made sense to do it. And it was a lot of work to get it done. It was a lot of brain damage to figure out how to do it. But here's the crux and the twist is that interest rates started going up. To buy out of this loan is very expensive when you've got a rate up here and the prevailing rates are down here. Now all of a sudden the prevailing rates are coming up. To get out of this loan becomes relatively cheap because the person has got that money locked up, but rather than take it back at a higher rate. We ended up refinancing it. We kind of saw two things happening. So we locked in the rate before it moved up too far. We waited to the fees out of this loan, so it brought down the cost of doing it. Huge windfall. Again, the point of all of this is that when you're looking at real estate, don't just look at, oh, this is a crappy rundown building, so I'm buying it at a lower price and I'm adding value by doing rehab. That's obvious. But there's all sorts of other opportunities and seek those opportunities. Sometimes there's a property where somebody has to get out from underneath it. There was a 6-unit failed condo building. Somebody bought it from the bank, and this is going back a while. So this is like 2011 or 12. Somebody had got this building from a bank, and now it's 2017, and they didn't know what they were doing. They cleared out the building except for one unit. They rehabbed. They fixed up all the apartments, painted them so they were all move-in ready. So you had a 6-unit building with one tenant in there, and then they put it out on the market for rent, condos for sale, buy the whole building.
Oh my God.
Well, nobody could buy a unit because a lender isn't going to make a loan on a building that has 5 empty units in them. You can't buy the building as a investor and get a loan on it because no lender is going to give you money on a building that's 90% vacant or 85% vacant. And again, I'm speaking from a spot, we've been doing this a long time, so we have different tools to draw into, but we drew from a line of credit. We paid cash for the building. We knew we could rent these units up really quickly. This building, by the way, is on the 3900 block of Kedzie, so Kedzie and Irving Park. It took us 2 months to fill up the building, and then we went to the bank with the rent roll and an operating statement and got a loan on the building. And the building is worth a lot more than we paid for it at the get-go, but nobody else the pool of buyers, if you look at, a room full of buyers, it all of a sudden comes down to just a couple people. So if you move quickly and confidently, you get the deal. So just to kind of conclude, the question is look for different opportunities. Don't assume that I just need to buy a building that I have to rehab. There's other angles on properties that can't sell that you angle yourself in and buy.
So Jeff, this 6 condo building, did you deconvert it into an apartment building or did you rent it as a condo?
It's funny, I'm trying to remember. I believe we deconverted it. There were 6 tins and we deconverted it. Yep.
Questions?
Thanks. So along the lines of what you were just explaining, where you're trying to get a loan for an apartment building, you said it's being assessed as more of a business as it is maybe real estate, like a single family home. So how do you go to a lender or bank or whatever and get an appraisal for, I guess, getting a good return on something where you made an investment on amenities or what have you, like you said, on the boiler or roof? That doesn't really translate into a T12 or anything like that. So yeah, I guess that's my question. How does that appraisal work? It probably takes into account part of that, and then the other part I don't know. So that's the question.
Yeah, so I think I'm just going to repeat the question because I'm not sure everybody heard it, and correct me if I didn't get this right. But I think the question is so you're buying an empty building, so whatever you put on paper is a pro forma, which I'll tangent to and make some comments about that beyond what you're asking. But so you're making up a pro forma. How do you go to a bank and get a loan on a property that has no real income statement because it's all made up because it's empty? There's really, it's zero income. The expenses that you have, right? You still have to pay property taxes and exactly right. So the reality is that a bank isn't going. Did I get the question right? Yeah. So yeah, you have a challenge because the bank, a traditional lender is never going to loan you the money on a building that's empty. Even me with the track record that I have, the bank won't give me. They won't give me 70% of the money. You know, they give me 30% of the money. I don't know, maybe. It requires creativity to find a place where you could draw money to get the deal done. You just need to be really comfortable that you have a very short timeline to be able to get to a point where you actually have numbers. Now, you buy this building, so we bought this building, and it was at one tenant in there when we bought it. 3 months later, it was full. We showed a rent roll. Now we created a pro forma off of that rent roll, but now the bank, who we also have a relationship with, so that's another piece of this, and I'll come back to that also in terms of relationships, but now the bank looks at it, they see that the building is full, they know that we understand how to operate the property, so now they'll give us a loan on that at a traditional rate and a traditional setup.
And there's no seasoning period on that? Like the moment you show you have like 6 leases, they don't require like a 1 year.
So
track
here,
record?
right? So here's the rub is, everything that you do is relationship based. Every step that you make, every interaction that you have, a relationship is really critical. So this was a while ago already, so things have evolved and changed, but people know us and trust us. We have the track record, they've seen what we've done, we have the history, so now it doesn't need to be seasoned. I mean, they see leases, right? They ask to see the leases, so those leases have 12, 11, 10-month tails on them, right? They're going to go through. That's enough for the bank, that they'll work with us. But again, this is because of the relationship that we have. I just want to talk a little bit more about relationships because, another tool that we've been successful at leveraging is, so when I had property on the south side, it's a little bit more challenging. It's a lot more work to manage those buildings. You have to chase tenants to pay their rent. Because you're chasing tenants for rent, you have a little bit more of an adverse relationship with them, so they're not happy. The tool that they have is to call the city. So now you're dealing with the city. But through those interactions with the city, going back 20 years of doing this, we developed a relationship with the city. We had some really, really tough situations where we had some things going on with the city, but whenever there was a problem with the city, our stance was always to solve the problem, to fix the problem, to make it go away in a meaningful way. And you find that the city is actually reasonable most often, overwhelmingly, not 100% of the time. In other words, if you do 80% of what they ask, it's usually plenty. Through that process, I developed a relationship where I bought 3 building portfolio a few years ago. It was 2020. We closed May of 2020, right in the middle of COVID. The guy that had owned those buildings, and he owned them for 20 years, he thought that he was right. He thought that he knew what to do. He thought that the city was idiots, and he thought that the city is telling him to do something, he doesn't have to do it. Across these 3 buildings, there were 100 violations, more than 100 violations. The city had a lien against 2 of the properties. We were able to, again, this is talking about relationships and why relationships are critical, is we were able to talk with the city, who knows that we're going to fix these buildings up. They know that in 6 months, these buildings are going to be off their docket, which they love. So we were able to go to the city, and the city agreed to take the liens off the properties. They put something on there called a consent decree, which basically is a legal term to say that if you don't do this, all of this stuff goes right back and it goes on you. But because we were able to do that, now going to our lender, a lender is never going to loan money if there's a lien against the property, right? And the city has a lien against the property. That's like a serious lien. But now, all of a sudden, the lien is gone. because of that relationship, and they know the history, they made the loan for us. We closed in May. By August, it was off of the city docket. It was a lot of work, but so relationships, I can't stress more how critical relationships are with everybody that you interact with, in realistically in the business and just your social world, but in business, because news travels fast and bad news will travel even faster.
And these lenders that you work with, are they like more local banks, or how?
So for us, I do most of my borrowing from Chase Bank.
Oh.
Chase has a very defined box. If you fit in that box, they're pretty hard to touch. Their rates are incredibly competitive.
Yeah.
Our model is we're going in with about 30% loan to value. So we're capitalized in a way that we're borrowing 70%, and everything that we do is non-recourse. But you have to fit in their well-defined box. So we bought a building, just about 7 years ago. It's on the 4500 block of Lawrence, and we came across this building. It was 2008, 2009 completion in terms of construction. It's 12 apartments on top of 10 natural stores, so 10 commercial spaces. The commercial, all but one of the commercial space were vacant. One of them had like a tax firm in it. There was another space that was built out to put a sandwich shop in it, but the owner, the developer, ran out of money, couldn't do anything. We went to Parkway Bank, we knew where the loan was, and we talked to Parkway Bank, and we convinced Parkway Bank to pressure the guy to sell it. So it was essentially a short sale, but it was a private sale between us and the owner. Chase would not touch that because it doesn't fit in their box. In that case, we went to Wintrust, and we worked out a deal with them, and we were able to put debt on it. Then we built out the spaces, we tenanted it out, and then 4 or 5 years later, we moved the debt over to Chase because their debt is just really cheap,
Right.
Relatively speaking.
So the majority of your properties are at Chase.
Correct.
They just require fully stabilized units.
Well, not fully stabilized, but relatively stabilized. Yeah.
Right.
Yeah.
Right.
We bought another portfolio a little over a year ago. Chris invested with us on it. It was 4 buildings owned by this guy who owned these buildings for almost 50 years. They were really run down in poor condition. And like that one, again, that's with Wintrust because Chase is not interested.
Right.
Eventually, we'll move it to Chase because it'll just be a better, more solid deal.
Right. Does Wintrust, do they do any type of construction loan?
Yeah.
Would they assist you with
Yeah.
that? Okay.
Yep. Yeah, so they'll do a construction loan.
Right.
They'll let you do the draws.
Right.
And they'll get creative with you. And there's lots and lots of lenders. Over the years, I've worked with a handful of other lenders. Again, after doing this for as long as we have, there's just very stable relationships. So
Right.
kind of have most of our stuff, like 95% of our stuff in 2 baskets, so to speak.
Oh, wait, Chris.
Yep.
So I had a question going back to when you first started. So, you're still working, you're in the IT field at the time, small portfolio, and you mentioned that over the years you've accumulated a lot of different tools that have kind of allowed you to purchase properties where other people may not necessarily have those same type of tools or resources or understanding to put the deal together to make it work. Is that just something that you accumulated over time? I guess how would you suggest learning those different type of strategies apart from the simple buy low, and
Right.
and be able to go from there?
Yeah. Tom Shellcross always says, high tides float all boats, right? So if you stick with it for the long time. I started with nothing. I really started with nothing. I've done pretty well. That's why when I talk about when I first started out, I had to sell a property. I had to flip properties. I should even say, I went out and got my real estate license, and I helped a handful of friends and family, buy a condo or a single family home to get that commission check, right? Because I had to pay the bills and get by. It took me a good 10 years of buying and building and growing till we get to a point where when you invest in that first piece, and I should also say that, so I bought a 2-flat, and then I got engaged, and I told the woman that I was going to get married to. 30 years later, we're still married, by the way. I told her we're going to buy another 2-flat. Because she was like, where are we going to live? I'm not moving into that place. We'll buy another 2-flat. Those are the only small buildings that I bought. Then I bought this 20-unit building, and kind of, things aligned where I kind of like flipped the switch and just switched and went into it. But it took it took a good 10 years. It's probably even a little bit more. It was like really 2012. 2012 was actually when it started to go in the right direction. But keep in mind, I don't know how much everybody in the room recalls 2008 and what came out of 2008 into 2009 into 2010. It was really rough. It was a rough few years there. But coming out of 2012 was kind of the starting point where my assets started kicking out a little bit more than what I needed to live on, which meant I started building a kitty of cash to be able to make another investment. And again, a thing that I could say is live below your means. When I bought I remember when I bought my first 2-flat, and then I bought that second 2-flat. I remember looking at people's credit reports, and I was 25 with the first one, 28 with the second one, and I'm looking at people's credit reports, and I'm like, yeah, that bottle of wine that they bought for $30, when they're all done with it, they're paying $150 for it, because they're spending their money. I mean, I saw people that had, they were working at the big 3 accounting firms at the time, Arthur Andersen and Deloitte and Big 4, and I would see these people, and again, we're going back to the mid 90s, and there'd be a couple that'd be coming in, and they're making 125, 150 grand a year, and they're spending all of it every year. They're just racked with debt. Live below your means and take that if you want real estate to work for you. Put every penny that you can back into it. Forgo that bottle of wine, that cocktail, that fancy dinner. I would say back at the time when I got started in this, I wore a suit and tie to work every day, and I sent my I ironed my own shirts. I didn't send them to the dry cleaner, and I say that I saved up enough money to buy my first apartment building by ironing my own shirts. But the point of all of this is that you invest in real estate starts working, you pour everything back into it, and then all of a sudden it's a snowball that builds up that's greater than you are, and then it starts to reap returns. When you get to where I am now, even earlier when I'm at now, it's like, the game, to invest, you've got the relationships, you've got the cash, and you make the next investment, and then it just keeps on growing it. So it's really important to build up that kitty.
Simple question and a more complex question. First off, you said they were lending at 70% of value. Is that appraised value or is that purchase price? And then second question is, you were talking a lot about relationships earlier. Are you sourcing your deals through relationships and buying on market, or are you doing any marketing directly to owners and sellers?
Okay. So the first question is an interesting one, because the banks magically, unless there's something weird going on, magically the appraised value is the purchase price. Very rarely is the appraised value different than the purchase price. It happens on occasion, and when it does happen, you know you did something right. But That's just the way that it works. Theoretically, the appraisers don't know what the purchase price is, but I think they do. But yeah, so it's now when you're refinancing, as an example, now what is it based on? So now they're looking at income, less expenses, your net operating income, and then they're putting a debt coverage on that. And just, they want you to have at least 1.25, 1.3 as interest rates go higher. The different tests change, but they're looking at that debt coverage. So whatever number that comes to on the top side, they'll loan you up to that amount. So that's where it'll fluctuate, and you could push the lender on it a little bit. And that's, by the way, where it becomes important when you're running an apartment building. If you're spending money rehabbing an apartment, so you spend $20,000 doing rehab work on a building, you spent $20,000. So $20,000 came from your bank account and went to rehab this apartment. But from a net operating income perspective, that's not expense. That's a capital expense. It's an improvement. It's a different number. So when you're going to the bank and refinancing, you want to make sure that you filter out all those capital improvements, driving your net operating income up. So now they're applying the debt coverage to it and they're valuing what it is. You'll get a multiple on that in terms of what they'll lend to you. So that's critical. Your second question was, so we're not, there was a period of time where we were going out and marketing and sourcing deals, but it's not our focus. But we do have a lot of deals that come to us because people know what we could do and how we do things. So like the deal that Chris invested with us in, the broker brought it to us. One, it was literally, it's 3 buildings on one block and then a 4th building a few blocks away. The broker knew we were the proximity, but they also knew there's not many people that are going to step up to do this. Again, this had a lot of violations on it. It was tied up in the city. It was really a mess and a really poor shaped building. So again, there's not many people that could do that deal. We're one of those people that could do it. So deals come to us for all sorts of different ways, and for almost every transaction that we've done, I could give you a thread of a story of why we were able to do it, and it happens. The one thing that I could probably generalize that should be most useful that I have been successful with is that I looked, the last building we bought a 24-unit building in Uptown. We closed in January. We made an offer on the building. There were 3 other viable offers that came in. We were really close, and the broker wanted to do the deal with us. They know us. They're like, just if you come up $100,000, you'll get the deal. And this is about a $9 million deal. So. I'm very disciplined in that I view it as I'm competing with myself. I think it's worth X. That's my offer. It went under contract with somebody else. Sorry, Jeff, the deal went to somebody else. Oh, well, it happens. Well, then that deal fell through because the buyer flaked out, had some issues, nonsensical kind of stuff, but it fell through. And then it came back. We were the lowest of the 3 other bids. We came up $25,000 just to be considerate. But we said, our number is what we think it's worth. We'll do this just in good faith. And we got the deal. They could have sold it maybe for a little bit more, but maybe it went to close. They knew that if we're signing a contract, we're going to close. So we've got a lot of people in the broker community that find us because they know that we'll close if we go under contract.
Yeah, you mentioned earlier that you buy distressed assets and then you try and add value. What are your thoughts on new construction? And I'm asking because I see Cook County Land Bank Authority has very cheap parcels that are $10,000 in, I don't know, which could be in the west side of Humboldt Park, which could be nice in the next 10 to 15 years. So what are your thoughts on new construction?
So I'm reading two sort of separate questions in your question. Because one, in terms of new construction, there's something interesting that's happening, particularly in the insurance space, and insurance companies are becoming very conservative on what they're willing to insure. They don't want to touch buildings that are more than 25 years old. And if you look at the housing stock all throughout Chicago, it's overwhelmingly, 80 years old on average. So, now you're stuck with like crazy insurance rates. Our insurance rates doubled last year. For the last 10 years, they've gone up 3 to 7% in a given year. They look at new construction under 20 years old very differently. So even I am starting to focus more on buying new construction just because it seems to be more safe with just the insurance component of it for a host of reasons. If you do buy an older building, paint your roofs, because the insurance companies just use satellite imagery, and it's like, looks like a new roof, okay. If it looks like an old roof, like you'll pay substantially higher in a premium, or they won't even insure it. So that's one half of your question. I don't do any real work with the land bank stuff or the stuff that's in foreclosure or the tax sales or things like that. But there's great opportunities there. It takes focus and understanding because you can't really look at the property, so you don't know what's wrong with it. So it's a different risk component. At the same time, it's incredibly highly discounted. So at that level, you know that whatever problems might be there, worst case, you're still going to do fine versus phenomenal. So now you're talking about the location, and that's a different gamble that's harder to quite express. But if you're talking about like buying single family homes that you're rehabbing and then flipping, if you're comfortable and you know that somebody is going to buy that building, right, that you can be able to sell it. So, you buy it for X, you put in Y, and you're selling it for something larger than X plus Y, do it. But I would definitely, in those cases, the one thing that you can't control it, but you could research it, is the location, right? You could say, like, I know what I'm up against, yet with all of those things, I could create some value here and there's going to be interest versus, maybe a situation where I either can't get there or I know there's like something going the wrong direction.
Hey, Jeff, I also have a two-part question. First one is, you've talked about you bought your first 20 unit, people saw what you were doing, they wanted to invest with you. So on partnerships, I know it could get pretty complicated, but what's this one or two simple ways of structuring partnerships in terms of, hey, you're the boots on the ground, you're finding the deal, you've got the plan, you're bringing X% of the money, they're bringing Y% of the money, and you're 50-50 owners. Okay. One or two sort of scenarios that would work that you've used. And then the second part is, as it relates to relationships and building a reputation of somebody who gets things done. Personal question. I had a situation recently where a deal I was a lower offer, deal fell through twice. They came to me, but by that point, the seller was mad at the agent, and the attorney got in their ear about this other guy can actually get it done, when I was telling them I could get it done all along. But by that point, I didn't have the reputation. So I'm thinking, like, is there any kind of portfolio you put together with like past projects or something along the lines to convey, hey, this is what I've done, I'm the real deal, even though I don't have 900 units, I've got these units and I can get it done.
So the first question was about deal structure. The second question was, so if you're starting from zero, how do you establish a relationship that actually has asset value to it? So the first question is easy to answer. The second question is a little bit trickier. In terms of the deal structure, when I first started doing this, I had seen other real estate deals. I asked people to look at the deals. And what I would just say is, keep it simple, especially when you have no background or history. So you look at a lot of deals that, you know, you're going to get this percentage, and then if we make this much, we're going to give this preferred return. If we make this much money, we take this percentage, but above this, and there's these all complicated and detailed waterfalls of, you know, I take more and more and more. But then when you really peel away the opportunity and you look at it, because all of the deals are structured that things are going to go well, right? They'll go okay or better or phenomenal. Nobody ever looks at the deals, well, what happens when it goes bad? What happens if it starts to fail? And the smart investors and the investors that will stick with you forever if you get them in early know this. So when you structure your deal, I think the two critical things are, one, keep it simple. Like it's not complicated, you know. You know, something as simple as along the lines of, you know, when we refinance or when we sell, all money out is first money back to the investors, and then everything over that we're going to split in some way. And whether as the principal you're taking 25% of that or 75% of that, that's kind of negotiable and also, you know, dependent on the type of project that it might be. But the point is a lot of these deals where, you know, you go in there and you don't have the experience, and you're taking this fee and you're taking that fee and you're taking this asset management, and when we sell, we're doing these things. It basically says that when things go bad, as the principal on the deal, I'm going to run for the hills and leave you hanging, and you're going to lose everything. I got no real skin, so, you know, I got nothing to gain here, so I'm out of here. Good investors aren't interested in that. Good investors want to know that you're going to stick in the deal. When it gets tough, you're going to stick in the deal. You're going to figure out how to fix it and make it work. So, so from a deal structure, when you're looking at deal structures, the simplest deals are the best deals. And then it becomes, you know, a matter of how much money are you putting in? Because if you're putting in real money and, you know, maybe they're putting in a lot more, like you're putting in 25% and they're putting in 75% versus, you know, you're putting in 5% and 95% is coming from the investors, you know, it starts to change. The second question was about reputation, and that's really tricky. But I have to say, and you know, there's a few people in this room that know who I am, and I'll say this in the context of where I am in my life and in my career. I'm going to turn 61 in June. I've been working hard for a long time, and where I stand today, and I look back and I reflect. I just sold my company, I was saying earlier, and you know, it paid a really nice reward for it, and there's a lot of opportunity for what we're going to be able to do with it. And I look at them like, how did this happen? It's a slow process, but everywhere you are, everything that you do matters. You know, I'm gonna stand on a soapbox for a moment and talk about something that's kind of relevant and important to me. Is first off, landlords. We don't use that word, right? What do we call us? Right, there you go. We're housing providers. Housing providers do a lot of good, help people every day. I mean, I could tell you stories. If for anybody in here who has a tenant and has had tenants for a few years, I'm sure has a story of how they've actually impacted somebody. We do a lot of good work. There's a lot of people that buy apartment buildings and think like, I'm going to buy the building, and tomorrow after I close, I'm going to kick everybody out. And I had this is pre-COVID, so it was like 2019. There were a group of people, of owners that were getting together, and they invited me to it, you know, and I knew who these people were. I wasn't doing business in their geography. And the whole conversation was about how much should you budget in legal fees to fight the tenants when they come after you because you're kicking them out of the building, you know? And the general number was, you know, for a 10 to 30 unit project was $100,000 in this conversation. And I'm just listening to this conversation because my style is, when I buy a building, in a rundown building that's not been managed well, what I know is that when I show up and we put structure in the building and we're highly focused on service, so we're going to take care of the tenants that are there, we know that there's a category of tenants in that building that just know that they can't get away with what they've been doing, so they disappear, they leave. Then there's tenants in the building. This is a 20-unit building, then there's tenants who, they see what you're doing, how you're fixing up the building, and it's like, oh, I can move into that nicer apartment. It's going to cost me a little bit more. I'll do it in a heartbeat. And then there might be 1 or 2 people, 3 people left in this property that, they're gonna be there for a while before they move out. Everybody eventually moves. Circumstances change, people's life change, people die, things happen, so they eventually move out. So reflecting on this situation back with this owner group, I'm like thinking, okay, so you're investing $100,000 to look like a bad guy, act like a bad guy, and not be liked. Versus the approach that I prefer to take, where people actually like me. The tenants in the building like me. They're happy to be there. They see that we're taking care of them. We kind of have their back. The community likes us. The city of Chicago likes us because they see that we're doing right. So they help us when we have problems. You go listen for Anthony Rodriguez in the Straight Up Chicago podcast. I want to say episode number 182, but I don't remember which one it is. But we had a boiler blow up at a building in January of 2024, and we had a 30-unit building. There were 17 tenants in it, and we took care of everything. You can listen to that episode and hear the details of that story. But the city helped us big time to be able to get through this. The alderman worked with us. We did some things too, right? But the short of this is that we make choices in how we behave and act and interact and build relationships. I'd rather people like me than dislike me. So those little things that you do now are the things that now, when you go back to that broker early and you don't have the examples, the concrete, tangible reputation, but there's this aura about you. Now you get to have the opportunity to go back and say, help me get this deal. And people will want to help you at that point, and you'll have better odds. And then, of course, it just builds on itself.
Question? Yeah, one shot to this?
If I
The first and the last. Oh, is this the last question?
Here.
So Jeff, question. So selling your property management business, was that something you had planned for 20 years ago, or was that something that came up as a good price? How did it work for you, for your portfolio of, I think, 500 properties and your third-party management of 400 odd doors?
Okay. So when I started, I didn't have this idea, these thoughts of this in terms of selling the management company until 3 years ago. All of a sudden, I'm kind of approaching 60, and I'm thinking, where am I going with this? I know that I don't want to be 65, 70 years old, not only walking up flights of stairs. Property management is a really hard business, and it's even harder today. We need to have a discussion of should you hire a property manager. That's a whole different topic. If you have 2 or 5 or 10 units, you could do it on your own. But when you get more than that, all of a sudden to comply with all sorts of things, there's challenges. But this is all to say that I knew you get the noise complaints, you get the this, the that. You're a social worker in this business, and it's hard work. I love it. I absolutely have loved every minute, and I continue to love it. But I don't want to be doing that, when I'm 70 years old. So I knew that I needed to have an exit strategy. And 3 years ago, I started talking with people, and it became the 2030 plan in my mind. When I would refer to it, I'd actually refer. It's the 2030 plan. It's a 2029 plan, but 2030 is a round number. I turned 65 in 2029 is what it's about. But I started thinking okay, how am I going to get there? So I started, talking to people, understanding things. At some point, you get calls out of the blue. I get a lot of calls for people, they want to buy the management company. They really want to sell me a franchise. It's usually bullshit, but yeah, occasionally you get somebody in there that actually is a real person, usually like a business broker. So I started learning, what it required was if for the property management company. Again, I think Drexel Properties. I'm curious, how many people in the room have heard of Drexel Properties before they heard this event? So people know who we are, and I've worked and I've built a team. We built a culture in the company, all of these things that I thought were really important. So I have this asset. So what am I going to do? Just hand it to Kagan Management? Here you go. You take over management, or Peak Properties. You take over management of my properties, right? I created an asset. So I learned that it required, first off, growth, which I was growing on my own, but it also required third-party management, which I had always been doing, but it was sort of circumstantial. The building across the alley from my office, it's been owned by the same family forever. The guy that owns it is getting up in age. The kids who are nearly my age are saying, well, we don't want to sell the building because this is good nest egg for cash flow. We need somebody to manage it, and I get one of the calls, and I'm like, if you don't hire me, I'm going to be insulted because I'm right there, But it changed that, to proactively go after and sell our services, and it was really based on I believe that we have a really good platform that manages all of this. We have a really good attitude. We got a really good mechanism for hiring good people and retaining them. We've got really good disciplines in our approach. So we have all of that there. So the conclusion was you have to grow. If I'm going to hire staff and kind of, let them take it over, or if I'm going to sell it, I have to do either of those things requires growth and taking on third-party management. This opportunity came along, and frankly, 2 years ahead of my schedule of when doing this, but this is a really good match for where I am and the opportunities that it creates for me to really grow this thing, because I'm not going anywhere. I'm sticking around for a while. So we have something that we could take what we're doing and continue to grow it and make it bigger and better. So I don't know if that answered your question.
Sure. Is it working? Testing. All right, perfect. Well, Jeff, thanks again for giving us a plethora of knowledge today. Everybody give Jeff a round of applause. At this point now, we're going to go ahead and continue on with our networking. So before we do that, we're all going to ask everybody to go ahead and line up along the back tap wall right there. We'll go ahead and take our group picture for the month, and then we'll go ahead and start our networking. So thanks again.
All right.
Awesome stuff, Jeff.
Oh, good.